The U.S. escalation of the Cold War with China is a political move by Trump. Analysis http://ntv4x.com News ID 8795C287 2020 12:52:58 p.m. Outlook. The market mover today is, of course, non-farm payrolls, currently forecast at 1.48–1.5 million new jobs and a decline in the unemployment rate from 11.1% in June to 10.6% in July. This is still a recoveryâ if at a decelerating pace. Hereâ the real problem. The data stinks. May and June saw a recovery by 7 million jobs, which supposedly offset the loss of 22 million jobs in March and April, but when both numbers are known to be inaccurate, we have no business drawing inferences from them. The WSJ quotes an economist from MacroPolicy Prespectives: on balance, we're still in a hole. The pace of recovery has really been set back by the resurgence of the virus. Given how far we have to go to re-employ the people who have become unemployed, that's very discouraging. The stinky data generally tends to exclude special cases that show job improvement is far less than the headline numbers suggest. Wolf Street delivers this chart, showing in blue the 15.85 million claiming benefits under state programs, and in red, those claiming unemployment insurance under all other programs, up by 2.27 million to a record 16.27 million. What are those other programs? The Federal Pandemic Unemployment Assistance (PUA) and Federal Pandemic Emergency Unemployment Compensation (PEUC). Plus workers on STC work share pro rata hours, federal employees, newly discharged veterans, and extended benefits. A special federal program for THOs who have used state benefits but the state has high unemployment. One way we know the jobs data is lousy is that credit card spending fell. Surprise you would think spending on credit cards would go up when so many people are unemployed, but in fact, total household debt fell between April and June by $34 billion or 0.2%, the first decline since 2014. Of that, credit card balances fell by $76 billion, the biggest drop ever. If consumers had confidence they could pay their credit card bills, they would be raising those balances, not paying them down. This bodes ill for next week's retail sales. More important than the numbers, which can't be good, is that Congress can't get a fresh recovery bill passed and millions are losing those special unemployment benefits, along with the end of small business loans. Trump can do a limited number of things like suspend the payroll tax, but only Congress has the power of the purse. In sum, the government does not have your back. The timing of the Trump attack on China is excellent as an effort to offset populist anger at Washington with something shiny. The U.S. escalation of the Cold War with China is a political move by Trump, who recognizes boiling resentment against China among his base and beyond it, too. But it also has a germ of justification, especially the forced delisting of companies that do not comply with U.S. audit rules. The WSJ reports that of the 283 U.S.-listed companies whose auditorship compliance can't be verified, according to the Public Company Accounting Oversight Board, 251 are based in Hong Kong or China. Being forced to move to another country or just go home will damage the Chinese listings. Most foreigners buy Chinese equities outside China. They hold only about 4% of the Shanghai and Shenzhen exchanges, and the value of the 249 Chinese ADRs is $1.5 trillion. The WSJ snidely notes that if the moved from the US to Hong Kong, it would be to Hong Kong's benefit. Bottom line, payrolls will not likely move the FX market much. Trump's new escalation of the Cold War with China points to scaring some, but not a shock that will drive anyone to the safe haven dollar. Meanwhile, negative real rates are driving all available funds to equities or gold. There really are no other viable choices. We all have to become stock market gurus now. We still think commodities are a fine thing and will fare well, too. We may need a correction in the oversold dollar, but not counting on it to amount to much. Still pair positions going into next Tuesday. On the subject of shiny new things, Goldman offered one up yesterday. The incoming new vaccine will be a game changer in the stock market, turning the GDP outlook from negative to positive on a dime and restoring non-tech companies to interest by investors, institutional and retail. Some of the argument is positioned as vaccine versus non-vaccine outcomes, which is presumably some kind of decision theory. NBSP tidbit: what is wrong with this picture? NBSP this is an excerpt from the Rockefeller Morning Briefing which is far larger, about 10 pages. The briefing has been published every day for over 25 years and represents experienced analysis and insight. The report offers deep background and is not intended to guide FX trading. Rockefeller produces other reports in spot and futures for trading purposes. To get a 2-week trial of the full reports plus trader's advice for only $3.95. Click here NBSP. If you want to read real-time news, text messages to MT5 Expert Advisors page at https://m.me/mt5.expert.advisors.